So there's a very big difference between a short-term capital gain and a long-term capital gain. But first, what is a capital gain? So this is where you buy an investment and you sell it at higher than what you bought it for. Perfect example is you buy a stock for $10, you later sell it for $15. The $5 that you gained on that is going to be taxed to you. How it's going to be taxed depends on how long you hold it. So if you hold this investment, if you buy it and you hold it for less than 1 year, then you're going to pay short-term capital gains. If you buy this investment and you wait longer than a year to sell it, you're going to pay long-term capital gains. The biggest difference between the two is the tax rate you're going to pay. If you have a short-term capital gain, you're going to be taxed at income. So this can be anywhere from 10% to 37%. For a long-term capital gain, most people pay 15% in taxes. However, depending on your income, you could pay 0% or you could pay 20% as well. The long-term capital gain is going to be preferred because it's going to be at a lower tax rate. Even if you're a high income earner, you would rather pay a 20% long-term capital gains rate than a short-term 37% at your income rate. So most of the time where we see people have short-term capital gains, it's because either they weren't aware that there's tax differences based on how long you own the investment. The other time, it could be worth just going ahead and recognizing a short-term capital gain because maybe you think that investment's going to drop dramatically to where if you try to hold it for past that 1 year period, you may not have gains anymore. So in those instances, it may make sense to sell it earlier and go ahead and pay the income rate for taxes short-term.